Hi, my name's Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And okay, it's been a long time coming, but I'm really pleased that today I get to share my How to Choose the Best Super Fund for You report. In the past, in the last 4 to 5 years, I've completed an episode about super returns, looking at returns over the last financial year that's just concluded, and then added some sort of commentary onto that. That's been useful, I think, but doesn't necessarily help people choose the best fund. At the end of each episode and blog each year, I've highlighted, I think Vanguard or UniSuper is the best, but it's not going to be the best for everyone. And so last year, what I did is I promised to, put a little bit more work behind it. And what I wanted to do is come up with a well-informed, educated, evidence-based framework to help people weigh up various superannuation options. And ultimately, I believe it is one of your most important decisions, especially for very young Australians. If you think, someone in their 20s, if they pick the best super fund and stick with it for the next 40 years, that could have a huge impact on their end balance. Whereas if they chop and change over the course of their lifetime or make some really ordinary decisions or are completely disengaged with the decision of where their super is, of course, that could end up costing them, and it probably will end up costing a lot of money. So I don't think it takes a lot of effort, but I think it's something that, most people should revisit every 1 to 2 years. But hopefully the goal is really to make a decision that is going to be the best over your lifetime. Not necessarily the best over the next 1 to 2 years, but on average over your lifetime. And that's why the league tables, which are always published around this time of year, which compares, which super fund topped the table in terms of returns last year or over the last 10 years. And we're kind of trained to follow those return tables. Now, I've got those tables in the report just because they're still important, of course. Returns are important. But the reality is that the approach to choosing a super fund, it encourages you to take a wrong approach by looking at those return tables. Because the best process is pick the structure first and then think about all the things within that structure. So the way that you're going to invest or your investment option, these sorts of things, those decisions can occur within your chosen structure. So get the structure right first and then think about all the things that can drive returns. And remember, super funds can window dress returns. I'm not suggesting they are, but it certainly is common within financial services because returns attract money, and money, if everyone's going to a particular super fund, the people that work in that super fund, their job is safe. So there's a strong incentive to try and make your fund as popular as possible, and so there is an incentive to window dress returns. Now, funds can do that in various ways. They can just chase returns for that particular year just so they can end up at the top of the table. But that approach might not necessarily serve themselves long term. That's why looking at returns is incorrect. You've got to look at structure and then returns. So that's how I want to break up today's episode. The first part of the episode, I want to talk about the investing, how your money is actually invested inside super, which of course is an important decision. And then the second part is to take you through 4 decision matrix or flow charts to work out the structure, because the structure is the vehicle that holds those investments. And, whether that's a pooled super fund or whether it's members direct or whether it's a wrap platform or self-managed super fund, the structure is the important part because you can work within that. The reality is the investment decisions can be made within that structure. As I said, if you want to go all growth, you could go all growth in a pooled super fund. You could go all growth in a wrap product or a members direct product or a self-managed super fund. Doesn't really matter. And I think this is really the core of, or the crux of this report, in that I help you choose the right structure, hopefully a structure you can stick with and that's most appropriate for your lifetime. including obviously while you're working and then, when you move into retirement phase. And then the investment decisions can change over time depending on what your preferences are and what the market's doing and, what's attractive at the time. So let's talk about briefly that first decision, which is, how you're going to invest your super. And then let's spend most of today's episode on the structure, and I'll walk you through it. And then, of course, you can download the report. Okay, so let's get into the structure. There's really 4 categories of choices, I guess, or 4 major decisions you need to make with respect to how you want your super invested. The first one is growth orientation. And so how much of your balance is invested in growth assets and how much is invested in more defensive style assets. In growth assets, property and shares tend to be the 2 major growth assets. Property assets inside a self-managed super fund typically tend to be unlisted assets. So we're going to talk a little bit about that later on. And my view might be you want to sort of minimize the amount of unlisted assets just because of accountability and transparency around them. So really what we're talking about is how much of your balance is invested in the share market versus other asset classes. Now, we know that over multi-decade periods, share markets, where you look at the ASX 200, S&P 500, or the global index, MSCI index, the returns are around about 10%, if you look over multi-decade periods. So there's no guarantees, of course, that's what it's going to be in the future, but that's what it's been in the past. And I think it's probably a reasonable expectation that 10% is the right number. So therefore, we know that if we put all our money in shares, we're going to have higher volatility. But my argument would be, does volatility really matter? I mean, it does from a behavioral perspective, because if you've got a lot of volatility and you decide to switch out of an investment option at completely the wrong time, that's not ideal. But putting aside, emotional-led incorrect decisions, just looking at the evidence tells us the way to maximize your super balance is to earn the highest average return over your time horizon. Now, your time horizon, don't forget, isn't necessarily age 60. Like if I'm 40 today and I want to retire at 60, it's not necessary that I've got a 20-year time horizon, because it depends on longevity and, how you want your balance to behave. And really, if I'm going to be alive until I'm 80, then my time horizon's 40 years. And my goal then is to earn the highest average return over that 40-year period, because then my money's working as hard as possible for me. So the best way to do that statistically and evidence-based wise is to put all my money in shares. So that's the first question you really want to think and think critically. I just don't understand why we've come up with this balanced growth, high growth, conservative investment options, and the rhetoric just generally in the market is, choose something that suits your risk profile. How does your risk profile react to not having enough money in super? Isn't that the highest risk? Not volatility. Now, of course, that's stupid, right? Because there's some behavioral matters, as I said, behavioral considerations. If you're going to chop and change out of investment options just because there's volatility, I mean, volatility is the ticket to the dance, really. You can't have the good returns without the volatility. So I would argue returns are more important than volatility. Volatility, just stop looking at your super. Returns, put it all in shares. Okay, so that's the first decision. The second decision in respect to that share allocation is how much you want invested in Australia and how much you want it invested internationally. Now, you might recall that Campbell recorded a great episode 397 back in February this year around share allocations towards Aussie and international. And, the idea is, that Australia represents less than 2% of the value of global developed markets. But why then are Australians investing 20 to 40% of their super balance in Australia? Why? It doesn't really make a lot of sense, particularly as we've got sector concentrations both in financials and materials, so the 2 miners and the 5 banks. And the Australian market has a hallmark of paying out high dividends, which means you can't get good growth out of Australian companies if they're paying all their profits out in dividends. It's just dumb business. And you're missing out on 98% of what else is out there globally. So to us, it doesn't make a lot of sense. We think the home bias is a bit silly. Just because you happen to be born in Australia and you're, investing in Australia, how should that really change your approach? If you were living or born and lived in the UK or Europe or US, you're probably not going to put 20 to 40% in the Australian market. So that's something to really think carefully about. The third question or decision you need to make in terms of how you're investing your balance is investing methodology. So do you want an institution to manage your money? So, it might be UniSuper or an industry fund that, makes a decision on how they're going to allocate money, and they'll have mandates with active fund managers to manage portions of it. They'll manage a reasonable share in-house. So they've got investment teams in-house, which means that they've got to, find good, talented Australians to be able to manage that money from Australia. They won't necessarily have trading desks globally like Vanguard does. Not necessarily a huge disadvantage, but certainly there's an advantage of having trading desks around the world just in terms of reducing fee and cost drags. Or do you want to have even an enhanced indexed approach? So where you're using various index methodologies. And I recorded a episode about that in July last year, episode 313, where I talked about the different index methodologies. And I also recorded an episode earlier this year. Let me look that up. That's right. In April, how to construct ETF portfolios. So episode 405, where I talked about, understanding the risks and opportunities and these sorts of things. So how do you want your money to be invested? What methodologies do you want to utilize? And then lastly, the last kind of two questions are really currency risk. So if you're investing overseas, do you want to hedge or use some sort of hedging, which really means taking the currency movements and risk out of the equation if you're hedging, so that you're really exposed to the underlying performance. Because what could happen, for instance, is your investments could actually do well, but if the Australian dollar appreciates or the overseas currency depreciates, then of course that eats away at the return. So the currency return can offset the actual underlying return. And in addition to that is gearing. Now remember, I did an episode about gearing into super as well, but do you want to include some gearing inside your super fund? And the reality is, for most people with these four decisions, the fund has already made it for you. But these are the things that I think you want to really test and critically really think about. And that's why I put the report together, so you can do a deeper dive in any of these particular four questions or four areas to really understand and make a more educated decision. Okay, as I said, they're the investment decisions that you need to make, but those investment decisions need to be made in the structure that you've decided. So I know the first step is deciding which structure. And so that's what the report helps you do. What we've done is we've determined identified four factors that really help you determine which structure is best for you. So those four factors are transparency and accountability, tax effectiveness, cost, and flexibility and control. And so each factor has its own flowchart where you make the decisions firstly based on, the factor considerations and then the investment considerations. And so then each of those flowcharts will point you to a particular answer. So it might be UniSuper, it might be a wrap platform, might be whatever it is, right? And so you go through each of those four flowcharts, and if the answer across all four flowcharts is the same answer, so if it's invest in international shares in UniSuper, for example, on all four flowcharts, then it gives you high conviction that UniSuper is the answer. If there's three answers that are same and one that's different, well, you've still got a pretty strong conviction of where to go. If the answers are all over the place, well, then it probably means you need to delve a little bit deeper into, some of the answers that you might have made and think a little bit deeper about it, or even potentially go and get some personalized advice. And there's a diagram at the front of the report that sort of shows it, how it all works and kind of brings it together graphically, hopefully that it's easy to understand. But what I really wanted people to do is not just educate them about, what are the important considerations they need to take into account when choosing a super fund, but I wanted the report actually to give them the answer, and I wanted that answer to have enough nuance. Now, nothing in the report or obviously in today's podcast is personal advice, of course. I don't know you, I don't know your personal circumstances. This is just a tool, and a tool is going to be useful for hopefully most people, but not everyone. So for some people, it's just not going to be, it's not going to give them a clear answer, but that's okay. I just want to make it really clear. It's an important decision, so you need to make an educated decision. Hopefully this report certainly helps you do that, but don't necessarily just rely on the report in of itself. So I don't propose to go through each flowchart here in detail. I just want to give you a bit of a taste of how it works. Essentially, the first question for most of these flowcharts is your balance. Is your balance over or under a certain threshold? And when we look at these balances, we're really talking about your balance plus your spouse, if you have one. So we're really talking about the amount of super in your family group, if you like. Then we ask about your investment preferences and approach, the 4 questions or 4 factors that I just spoke about. And then based on those questions, we make a recommendation in terms of which product or which specific fund or which specific investment option in which specific fund. So let me give you an example using flowchart C in the report, which is all about cost, because a structure is going to dictate what sort of cost. The first question is, do you and your spouse, if you have one, have more or less than $500,000? Or we'll be close to having that benchmark in a relatively soon. Now, what is relatively soon? I don't know. It depends on how cost sensitive you are. But, if you're going to be there in the next sort of, 1 to 3 years, then you probably answer yes to that question. If you're miles away from it, then of course it's a no. And the reason that $500,000 benchmark is important is because the fee environments in industry or in pooled super funds, industry super funds, tend to be very percentage based. So they have low dollar value fees. They might charge you $1 or $2 a week as an admin fee. And the other fee is then a percentage fee. And the reason for that, the reason it works like that is that in industry super funds, they tend to have a lot of low balance members. So members that don't have, huge balances. And so a percentage based fee works better for them. But the problem is the members with higher balances end up really subsidizing the costs of lower value members. Also, if you're paying, I'll just make the maths nice and easy. If you're paying 1%, you're not. But if you are paying 1%, and you've got $500,000, you're paying $5,000 a year. If you've got $1 million, you're paying $10,000 a year. Do you really want to pay twice as much? It doesn't really cost twice as much to manage that double the amount of money. Do you know what I mean? There's got to be some scale in there as well. So that's where we come up with the sort of $500,000 benchmark. The next question in the cost flowchart is, how much control and transparency do you want to have? So if you say, no, I'm happy for someone else to make all the decisions and manage the money, then something like Vanguard Super might be better. If you're happy and you've got the skill and experience to really dig in and make your own investment decisions, then a members direct option might be better. And then you can just use a variety of low cost or even diversified ETFs. And then we ask questions around, well, how much in shares, how much in an Australian share market, what sort of investment methodology. Anyway, and it branches out into various recommendations from there. And the final one in cost, the final step to check, and one that, I think a lot of members forget about, is insurance. And I think I made a comment recently that insurance is an important one. Firstly, there's 2 important factors. Firstly, if you're not able to get replacement cover in the new fund. So if you say, okay, I'm in with Super Fund A, but I really need to move to Super Fund B because it's better for me. You've then got to think about, will Super Fund B give me insurance? Well, if I've had a medical event, in between joining Super Fund A and today, so if I've had a cancer but I've recovered, for instance, I'm probably not going to get replacement cover. So that's the first thing to think about, is saying, okay, well, I've got to leave a minimum balance in Super Fund A and then just move the rest of my money to B. The second question is a cost question. And the problem with, and I've got all the information in the report, the problem with large super funds that have a legacy back book with insurance is they are expensive. So Australian Super increased some of their premiums by 40% last year. Insane. Whereas someone like Vanguard, for instance, doesn't have that benefit payment history, that insurance payment history. So they're cheap. And I can't say they're cheaper for everyone, but they're materially cheaper for the ones that I remember I did a few scenarios with their insurance calculator. So that's the other thing, because we think about admin fees, we think about investment fees, but if we've got insurance inside our super, we need to add that last element too. So that's the last step in the cost flowchart, which is flowchart C. Now that's C. Let me talk about the other flowcharts. Flowchart A is around transparency and accountability. Tests whether that's important to you as the member. So do you want to make sure that you have transparency in how your money's invested, who's getting paid, all these sorts of things. You want to break links with unions and the government. I mean, just recently, again, this is mentioned in the report, but just recently, you might have seen it in the news that Elbow had a little forum in Sydney around super, and there's some rhetoric around them using superannuation as a way of kind of advancing government policy, all those sorts of things. I mean, I think we want to keep, and in fact, the Westpac CEO said, no, keep your hands off our super. So things like transparency and accountability, I think they're important. They're certainly important to me. I'm not going to say they're important to you, but that's something you need to decide. Flowchart B is around tax effectiveness. So in terms of pooled versus unpooled structures, I've written about this. And again, of course, there's more in the report, but the wealth equation is surplus cash flow. In this case, it's super contributions multiplied by investment efficiency, which is earn as much as you can in terms of investment returns and keep as much as you can. Keeping as much as you can is reducing tax and reducing fees. And the final element of the wealth equation is time. And so to maximize your super balance, you want to contribute as much as possible. You want the highest average return over your investment horizon, lowest fees and lowest tax. And of course, you're forced to, leave it in there until you're at least 60. So that deals with the last element of that equation. But Flowchart B takes you through how to achieve the greatest tax efficiency. And lastly, Flowchart D is flexibility, something I think people really need to think very carefully about. And remember, flexibility, the more flexible an option is, the more likely you're going to be able to stick with it for your lifetime. And the more you're able to stick with an investment option or investment structure, a super structure for your lifetime, the more likely you are to be able to optimize all the other factors like reducing the tax drag, making sure it's invested well, all those sorts of things. Now, as I said previously, if all those 4 flowcharts give you exactly the same answer, then you've got a very high confidence. If 3 out of the 4 agree, I think it's a strong signal, and you probably just need to understand why you're getting a different answer in the 4th factor. And it might mean that there's a bit of a trade-off that needs to be made. So, for example, it might be, Vanguard Super might be the best today, but a self-managed super fund really gives me all that flexibility, so I might want to go in that direction. I'm not saying that, by the way. And look, I can't remember the last time we recommended a client to set up a self-managed super fund, so typically it's not going to be the answer, but something to really think about. Now, if you've got 2 different answers, so, you get one answer for 2 of the flowcharts and a different answer for the other 2 flowcharts, or in fact even 4 different answers, then you're in genuine trade-off territory. In that situation, I would say take the 2 most common recommended options as your shortlist, and then kind of compare them in terms of fee tables, investment returns, which are included in part 1 of the report, and then compare fee structures as well. So understanding the fee structure will help you understand how that fee structure is going to serve you as your balance grows. So really what you want is minimize the percentage fees in return for higher fixed dollar value fees. The higher fixed dollar value fees will give you the scale eventually. So even if an option is slightly more expensive today but has a better fee structure, that could be the thing that kind of separates the 2 shortlist options. And the other thing too is you don't necessarily need to take the answers too literally. So for example, if the answer is invest in 100% in international shares in Vanguard Super, for example, what that answer looks like is really a pooled super fund, 100% invested in shares, 100% of that invested in international exposure using low-cost indexing. So if there's another way to achieve that potential outcome, so that is if you find another retail fund that also allows you, that's pooled, that allows you to put all your money in international, that is also indexed, that could be a good substitute for Vanguard. So don't necessarily take it literally, although what I've tried to do is I wanted to actually give an answer where it's possible to give an answer because I want to make the report as useful as possible. But of course, there's always nuance with these things. I should also say that, if your situation has a lot of complexity, if the answer is set up a self-managed super fund, or you have a blended family, so you've got children from a previous marriage, or you've got unlisted assets, or you plan to move a lot of money into super, these sorts of things. I can't list every single scenario, but if your situation is relatively complex, the report may or may not be able to sort of help you navigate sort of big decisions like that. And that could be a signal to really get personalized advice. The other thing too, if you haven't really sort of understood what I'm talking about with some of these things like transparency and accountability, what does it all mean? Of course, the report is structured so there's 4 subsequent sections, and each section or part relates to a flowchart. So, which means you don't need to read the whole report. You might be able to go through the cost flowchart, really simply and easily without reading any of the report. But when you come to transparency and accountability, for example, you might go, well, I don't really understand that bit. So that way you can drill in and you can, I talk about transparency around unlisted assets, the political sort of situation, the how much money's been paid to unions and these sorts of things, all that sort of stuff. So you really educate yourself and you understand what's going on. And as I said at the beginning of today's episode, what I hope this report will do, because I will update it at least annually, but that's why I say if you've got anyone, if you look at the report, you think this is awesome, I want to share it with someone, I think someone's going to benefit from it, please send them to download it from the website rather than email them. I mean, you can email the PDF, but what I'm sort of saying is that if I make changes, I'll update the report that's downloadable from the website, and I might make updates throughout the year. In fact, if there's something significant that happens, I will. And I'll let you know if I do that in the podcast, of course. But that way that they're always going to get the most recent version. So my idea is that you can use this as a resource each year. Now, what I hope is that you're not chopping and changing super funds each year or making major wholesale changes, but it's important to go and revisit and ask yourself, okay, now my super is a different balance, materially different balance to when I considered it previously. Is this still the right structure for me? Or, is this investment approach or investment option right for me? The other thing too is you might not, it's not an all or nothing situation. So you might go, oh, look, I hear Stuart around the Australian exposure. So I'm going to reduce my Australian exposure, say 20%. And then I'll look at it next year. And if I become more convinced that, or more in agreement with Stuart, then I'll reduce it to 10%. So it's not an all or nothing decision, but it will allow you to revisit those investment decisions within that structure that you've got. Same with things like unlisted assets. You might go, I'm okay with it now, but I'll revisit it next year. Or insurance, it's another one. I mean, again, if Aussie Super has increased some premiums by 40% last year, and you did the analysis, say, 15 months ago, you might have been happy with the cost, but today maybe less so. So really, to sum it all up, the right approach is think about structure first. And for many people listening to this podcast today, it might be that they're in the right structure, that the structure answer is correct, and all they need to do is just sort of play with how their money is being invested. When I say all they need to do, that's still a big decision and can certainly move the dial in terms of your end balance, but it's not necessary that, I'm expecting that everyone that reads this report needs to change. But of course, if a change is warranted, better that you find that out today than, find yourself in the wrong structure for the next couple of decades during your working life. Anyway, I genuinely hope the report helps. I think it's going to be much better than the previous sort of iterations of a blog and podcast. Of course, you're keen to download the report. The link is in the show notes, and we'll have that on the website as well. And we very much hope that it helps. I should mention, by the way, I didn't even realize, I don't really listen to podcasts on Spotify. I didn't realize that Spotify allows people to ask questions and post comments. We've just turned that off. So if you do have a question about a particular podcast, you can certainly jump over to YouTube. So I answer a number of questions each week over on YouTube. If they tend to be sort of simple questions about a podcast, clarifying questions, if you like. The questions in terms of your individual situation, the Tuesday episode ones, keep on emailing them through. We'll get through them as I keep promising to do. But if you do have a short question about any particular episode, this one or a future one, go over to YouTube. I do make sure we try and get back to you. I personally answer those within a day or so relatively quickly. Anyway, I hope that's useful today. And if you do have my new book, Wealth by Design, I hope you're enjoying it. And I hope you utilize the Notebook LM tool that goes along with it. Until tomorrow, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favor to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.